Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. A reversal. An equity sell-off in Wall Street spreads to Asia as investors pull back from riskier assets amid renewed concerns over AI and Fed cuts uncertainty. The yen whipsawed after Japan's finance minister warned of potential FX intervention, with Prime Minister Sanae Takaichi poised to unveil a $112 billion stimulus package. Plus, a war of words between South Africa and the U.S. over the G-20 summit. It has been so far marred by a diplomatic dispute between the two nations over what constitutes participation in the conference. Well, good morning, everybody. It's just gone 9 a.m. across the Emirates. I'm Jemana Bersachi in Dubai. Well, we saw a bit of a market shakeout yesterday. Just to give you some context here, the MSCI All-Country World Index has fallen almost 3% this week. It is on track for its sharpest weekly drop since April the 4th, which is, of course, the week that President Trump unveiled those reciprocal tariffs. What you did see was a sharp drawdown, not just in equities, but across other assets as well. Anything that's pro-cyclical, risk on. You saw sharp declines yesterday, but you can see this morning the handover from Asia Pacific is quite negative. So we've got that index down 1.6%, very sharp falls in the Kospi, the Nikkei as well. We'll get to that in a moment as investors are getting increasingly concerned about the Japan fiscal package. But take a look at S&P futures. Things are actually looking up today. So we're up 0.4%, some stabilization coming through for those U.S. equity markets, which got beaten down yesterday in trading. The USD dipping somewhat, down about 0.1%. But again, the theme has been one of the USD benefiting from these risk-off moves over the last couple of days, especially throughout the course of this week. And for once this year, we are seeing the paradigm of the USD actually being a safe haven when investors are pulling out of some of these risky positions. And then Brent also in focus, in line with the broader risk-off sentiment. We are seeing oil continue to get clobbered. 62.5 is where we're at now for Brent, so getting closer and closer to $60 a barrel, down 1.3% this morning. Switching over, let me just draw your attention to valuations for the S&P. And the reason I bring this up is people have been talking about lofty valuations. And yes, we've pulled back marginally from the recent highs, but context, as we say, context changes everything. And we've come a very, very long way in the last couple of years for broader S&P valuations. And this is PE multiples, obviously. We're sitting at about 21.6 right now, pulling back from the most recent highs of around 23. So yes, still pretty lofty if you look at the comparison over, say, the last 5-6 years ago for the S&P. All right, let's also zoom in on how markets in Asia are faring. Min Lo is in our Hong Kong studio. And I was talking about the stabilization for U.S. futures, not the case for Asian markets this morning. Min, walk us through it.
Yes, indeed. It is a miserable day to end the week here in Asia. Another day of declines, and even that NVIDIA-led rally yesterday proving to be quite short-lived. That perfect report card, not enough to quell concerns around AI valuations. And you can see all the indexes here on the screen, especially the tech-heavy ones. The TAIEX, the Kospi, taking a beating, down about 3.5% or so. But we take a look at some of the chip stocks here in Asia, and you can see some of these chip stocks really taking a tumble, especially the likes of SoftBank, down about 10.5% here. SK Hynix down about 8%. So really, a bloodbath across some of these chip stocks here. But we're watching the Japanese assets in particular because it's a big day for Japan. They have the CPI numbers coming out at 3%, in line with estimates, but higher than the BOJ's target of 2%. It's been higher for 43 months now, and that just puts more pressure on the BOJ to hike rates. But you add to that, Takaichi unveiling her first stimulus package, at least $112 billion in the general account spending, 27% higher than the predecessor. And you have this stimulus package coming at a time when inflation is hot, and you're seeing the bond vigilantes coming out here. You can see the 30-year yield up about 5.9 basis points here. So you have the trifecta now. You have the sell-off in the bond. You have the weakening of the yen above 157 now. You have the equities also falling, and increasingly there are many voices now questioning whether Takaichi has her policy makes wrong.
Yeah. Okay. So a lot of focus on Japan, the fiscal situation there, and also inflation expectations, something that's impacting the GDP market. Min, thank you so much. Min Lo in Hong Kong. Joining us now is Manpreet Gill, Chief Investment Officer of AMEE at Standard Chartered Wealth Management. What do you make of the price action the last couple of days, this drawback that we're seeing in global equities, not just U.S.?
No, I think a number of factors coming together at the same time, because we had the stress in AI, of course, but it's also, at the point we're having a debate about whether the Fed can cut in December and a pricing out of those expectations and, the fiscal package and the concerns it raises for yields in Japan. So I think we've got a couple of potential worries all coming to the markets at the same time.
Okay, so not one particular driver, not, say, the Fed turning more hawkish.
I think that's one part of it. And I think I wouldn't quite characterize them as turning more hawkish. In our view, the labor market still justifies heading into rate cuts. We still think they'll cut twice by the time we get to the end of Q1. But the reality is we've got a bit of data fog. We're skipping a month's, labor market data, and we won't get, the November data till after the Fed meeting.
And to your point, we got the September data yesterday, and I think people were surprised. I mean, the headline figure better, but the unemployment rate ticked up to, 4.4% yesterday? Yeah, 4.4%. So do you think that later down the track may give justification for them to restart this cutting cycle once the data starts coming out more regularly?
Well, the data itself, highlights the challenge, because the unemployment rate ticking higher argues for cuts, but the number of jobs was, of course, higher than expected. And I think that's why we're getting this mixed messages from head governors, whether the cut is needed as soon as December or whether it's prudent to, potentially wait for more data. In our view, if you zoom out and look at labor market data, beyond just these two indicators, your new job creation, your sort of turnover, jobs, hard to get. All of that, in our view, still points to cutting rates from what are still somewhat restrictive levels.
Yeah.
The question is, at what point does the Fed get the confidence to do that?
Yeah, and probably they're just waiting for more data for that to happen. What do you make of the dollar holding up this time around? So one of the things that I've noticed in the last couple of weeks is, with this uncertainty, with some of the volatility picking up in global stocks, you actually are seeing money go back into the USD. So all of those concerns about U.S. exceptionalism being tested out of the window now?
Well, we've always been of the view that, the bigger picture de-dollarization story is a very long-term one, and that could very well play out. But I think what we're seeing is a reversal of two factors, right? I think one is just a simple counter trend that we had one of the weakest US dollar years in a couple of decades, so a little bit of year-end reversal of that. And I think U.S. asset performance has actually been surprisingly good. I mean, we all thought that, emerging markets are a big beneficiary. They've done well, but the U.S. has also held up in addition, partly due to what's happening in AI. So in our view, this is something we might see continue to play out over the next 1 to 2 months. Yeah. But in our view, if U.S. interest rates are indeed headed lower, if U.S. bond yields are headed lower, then we still think that tailwind for a gradually weaker dollar, that's unlikely to change. So the way we're addressing it is not to leave aside the U.S. We think U.S. markets will do well, but we still think continue to use these opportunities to add to more EM, more Asia is prudent.
Okay, it's interesting. One of our colleagues in London spoke to Carson Block from Muddy Waters, and he's a famed short seller, and they asked him about whether he would think about shorting some of those big names or poster child names in the AI space. And he said, honestly, no, I wouldn't at this point in time, because the momentum is too strong. It's very difficult to play against that tide. What does one do if you want to diversify away from AI, but you also still want to participate in the rally?
Well, we think there are two things. And to your point, we wouldn't let go of the technology sector exposure. Momentum strong, but arguably earnings as well. Look, the reality is, many companies are still delivering. But I think there are two things investors can do. I think one is, within the U.S., there are many other sectors not related to AI that we think still look interesting. I mean, pharmaceuticals is one example of that, where, valuations are not as challenging, and we've seen previous regulatory headwinds sort of go away. And there's the utilities sector, which arguably has a little bit of spillover from that positive momentum. The other one is actually look at markets outside the U.S. Because this entire valuation debate, AI debate, is very U.S.-centric and, arguably limited to tech sector. But Asian equities in particular should benefit from domestic stimulus.
At the same time, people were getting really bullish on Chinese equities. And look at the pullback in HS Tech. You and I were just talking about that before the show. We pulled back 20-30% from the highs here. That's a difficult one to jump into.
Absolutely. And I acknowledge that, look, Chinese equities by their nature tend to see large moves, whether on the upside or during the pullbacks. But I think the perspective here is that Chinese equities, we've seen support come through when we've seen weakness in markets driven by worries about the economy. But equally, the size of rally is limited by the lack of very strong stimulus. Yeah. So in our view, Chinese equities, particularly when you start picking sectors, offer enough room. In addition to tech, we still think consumer discretionary is one sector that's more linked to the macro cycle. But for us, also it's about Asia ex-Japan. If you look at Indian equities, in our view, it's a neutral core holding. But as we get reports suggest closer to US-India trade deal, taking away some of the headwinds, that can also help benefit a broad Asia ex-Japan exposure.
Okay, Manpreet, thank you so much. Really interesting. Manpreet Gill, Chief Investment Officer, AMEE at Standard Chartered Wealth Management. Well, coming up, a confusion on the participation of the U.S. in the upcoming G-20 in South Africa. We're live in Johannesburg with the latest. That is next. This is Bloomberg.
We have received notice from the United States, a notice which we are still in discussions with them over, about a change of mind about participating in one shape, form or other in the summit. So the discussions are still ongoing.
I saw the South African president running his mouth a little bit against the United States and the president of the United States earlier today, and that language is not appreciated by the president or his team. The ambassador or the representative of the embassy in South Africa is simply there to recognize that the United States will be the host of the G20. They are receiving that send-off at the end of the event. They are not there to participate in official talks.
A war of words between South Africa and the U.S. over the G20 summit, which has been so far marred by a diplomatic dispute between the two nations over what actually constitutes participation in the conference. Let's go to Johannesburg now and dig further into this with Jennifer Zawazaja, Bloomberg's chief Africa correspondent. I've got to say, beyond anything, it's sort of must be frustrating for everyone else who's participating in the G20 that this has become such a focal issue, whether the U.S. are going to participate or not. What went down overnight, Jen?
Right, Jumana. We were actually in the room there when President Ramaphosa was speaking, and he was speaking alongside European Union leaders, including Ursula von der Leyen. And we were quite surprised, as he also told us, that it seemed as if some of the claims that he was making was that the U.S. was, in fact, indicating that they wanted to participate in some fashion. Most of the reporting has been centered around the fact, as Caroline Levitt was stating there, that there would be some sort of representative from the U.S. to take the baton, as it were, for the G20 next year, which, of course, the U.S. is hosting. But as you were mentioning there, Jumana, there's really quite a bit of confusion because many people had sort of moved on. It seemed like many people had moved on from the fact that the U.S. Was not sending a representative. As President Ramaphosa actually said during that speech last night when he was taking questions, he said boycott politics do not work, and actually seemed to indicate that, in fact, maybe that he had thought there would be some sort of resolution. He said there was still a seat for the U.S. For these negotiations, but still many leaders have indicated to us that they want to at least try to move forward in some fashion and not make this about people or nations that are not necessarily in the room anymore. So the big question really that we're trying to figure out is what sort of representation will the U.S. have here, if at all? And really, what does this then mean, again, for any sort of declaration at the end of the summit? As we mentioned earlier this week on the show, the U.S. was quite direct in their direction and communication, telling South Africa not to declare any sort of joint declaration at the end of this because the U.S. is not present. So the question is, what, if anything, is going to come out of this summit? What are some of the these leaders who are, many of them are already in town and will be over the next few days, what are they going to be able to negotiate and find consensus on? And then really, what does this mean for the next G20, which of course will be in the US? I'm sure that if the past 24 hours is any indication, it will be a very busy next few days, and probably we'll likely hear from both of these presidents over the next few hours and days about where relations stand between the two of them, but then also more broadly what this means for multilateralism.
Yeah, and ultimately there needs to be that handover between the host of this G20, which is South Africa, and the host of next G20, which is the US. So that's, I guess, the terms of what they're disagreeing on over here. Jen, thank you so much. Jennifer Sabazaja, Bloomberg's chief Africa correspondent. Well, from the sidelines of the B20 summit in Johannesburg, Jennifer Sabazaja also spoke with John Denton, International Chamber of Commerce Secretary General, on the outlook for global trade and economic growth amid shifting geopolitical dynamics.
There's things that governments can just do. And that's something that we've been pointing out. I mean, let's face it, the US accounts for only 13% of global trade. So there's 87% which is out there. What we've been telling governments to do is get on board with us and actually let's work on principles to ensure that we actually increase economic activity, not in 2 years' time, but now. There's things that can be done. There are things that can be done in Africa about enabling the operation of the African Continental Free Trade Area. I think everyone knows the potential, but let's stop talking about the potential and actually let's translate that into actions now. Let's actually work to digitize the customs around borders to actually make it easy to get goods. That's called increasing economic activity. Right. And that's actually a low political risk challenge. It's just that it needs to be raised up the priority list.
Are you seeing willing engagement then from the public sector that you're speaking with?
Well, I think the critical issue here is not so much the public sector's engagement, it's the political ambition now. Governments actually have to issue clear signals to their bureaucrats to get on and do this, that it actually is an important priority, because otherwise it just gets lost. And so these sorts of things need to be activated. And frankly, one of the good things about the B20 this year in South Africa, and frankly, I know there's challenges at the G20 stream, which is obviously concerning everyone and has a lot of public attention. But the B20, which knits together the business communities from the 20 economies, is actually functioning seamlessly. And what the B20 is doing, and what I've been part of, is coming up with actionable projects to come out of this Johannesburg period, the South African period, and actually get on with enabling SMEs and business to increase economic activity. And we're doing that now.
Are you concerned, though, that that may not filter into 2026 when the U.S. takes over the presidency?
Not at all. I mean, look, if there's one thing that unites, I think, the G20, even with or without formal or physical presentation of the U.S., is the need to focus on economic growth. And you can't have economic growth without economic activity. You can't have economic activity without getting the private sector moving. So I think that's a unifying theme that will flow through. The U.S. will have different priorities, but that's perfectly appropriate.
That was the Secretary General of the International Chamber of Commerce speaking to Bloomberg's Jennifer Sabazaja. And coming up, the sentencing of a Nigerian separatist to life behind bars could further inflame the fragile security situation in the nation. We'll discuss these details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. A Nigerian court has handed a life sentence to separatist leader Nnamdi Kanu over terrorism charges. The ruling risks inflaming regional tensions and worsening the nation's already fragile security situation. Bloomberg's Ondiro Ganga joins us now from Kigali. Ondiro, why is this ruling so contentious for Nigeria's stability?
Good morning, Jumana. Because it risks bringing up fresh violence and fresh protests in the country. If you look at Nnamdi Kanu, he is the leader of the separate group IPAB, Indigenous People of Biafra. And what they've been doing is they've been calling for separation and the ability to self-govern, because they feel that since 1999, when democratic rule returned to Nigeria, they've been left out of government. They've been marginalized. They haven't been receiving high-ranking government appointments, and so they want out. The problem with this is that the government decided to label them a terrorist group in 2017, and a crackdown led to the arrest of Nnamdi Kanu in Kenya. He was deported back to Nigeria, and he has been facing trial. This life sentence on a man who's considered a political and cultural figurehead in the region is likely to spark fresh tension. It will bestow upon him something sort of a martyr status, and we're likely to see fresh unrest coming out of this. It also raises a couple of questions. Is the government keen on cracking down on dissent or finding political solutions to the political grievances that people have raised? And also there's some areas in Nigeria where we've seen the same conversation about secession and separation and other terror-induced issues, and the government is helping these communities negotiate. So why are we seeing selective justice? This is not largely a judicial issue. It's an issue that needs political solutions.
And at the same time, it seems to be having an impact on the president, Bola Tinubu. He cancelled a planned foreign trip to address the nation's security crisis. How is this shaping his leadership?
Jumana, economics have taken a back seat, and now security has become the focal point. And let's just map the security situation in Nigeria. In the north, you have Boko Haram, who are backed by ISIS. You also have bandits who are abducting people. You have Fulani herdsmen who are also causing terror in that region. In the southeast, you have the people who are talking about secession, separation, and it's also coupled with violence. In the Niger Delta, you have oil theft. You also have some form of violence and sabotage threats. This is a country that is dealing with deeply entrenched security issues. And these are issues that did not start today. These are issues that have been there before Tinubu, and from the look of things, the buck is not going to stop with him. There's a lot of corruption in the administration. There's very little investment in security personnel and security instruments, and then there's marginalization. You look at the north, some parts of that region, close to 90% of the people are illiterate. 10 million children in that region do not have an education. And so with President Donald Trump raising this issue a couple of days ago, it just brings it to light in the international scope. Now, all eyes are on Nigeria, and they're feeling the pressure. And you can tell that there's a lot of confusion within the administration. The Minister of Foreign Affairs is doing international press tours, but there's a lot of opaqueness in terms of the magnitude of the problem, the people who've lost their life. The president has cancelled this trip, or rather postponed the trip to G-20, but also for what? To receive updates on what they are trying to deploy more security issues. But unless the government is intentional about setting aside money for security, doing social development in the country, they'll keep struggling with the same issues over and over and over again.
Ondiro, thank you so much for the reporting. Ondiro Ganga in Kigali. Let's take a look at how equity futures are, because they're stabilizing after yesterday's drawdown. We had Nasdaq end the session down more than 2% by the end of the day yesterday. S&P also down 1.6%, and actually huge swings during the course of the day. Its biggest intraday reversal, 3.6% since the tariff turmoil back in April. But today things are looking up. We've got futures up 0.4%, Nasdaq also up 0.2%. European markets, however, take a look there, pointed to open deeply in the red. Some of that is catch-up because all of the negative price action happened after Europe had closed for the day yesterday. Well, coming up, we cross to Johannesburg to speak to Investec after their profits declined for the first time since 2021. That's next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. A reversal and equity sell-off in Wall Street spreads to Asia as investors pull back from riskier assets amid renewed concerns over AI and Fed cut uncertainty. The yen whipsawed after Japan's finance minister warned of potential FX intervention, with Prime Minister Sanae Takaishi poised to unveil a $112 billion stimulus package. Plus, a war of words between South Africa and the U.S. over the G20 summit. It has been so far marred by a diplomatic dispute between the two nations over what constitutes participation in the conference. It's just gone 9:30 a.m. across the Emirates. I'm Jumana Versace in Dubai. Well, a very tumultuous day for stocks yesterday. Just to put it in perspective, intraday, the S&P moved 3.6%. That's its largest intraday move since back in April, since Liberation Day. On course now, the MSCI Global Index also on track for 3% losses in the week, the worst week since Liberation Day as well. So lots of volatility in these markets. A big drawdown for Nasdaq, with that index down more more than 2% yesterday in trading. Today, though, things are stabilizing. S&P futures up 0.3%. Not so pretty, though, for some of these Asia-Pacific indices, a lot of them coming under selling pressure, and the likes of the Kospi, Nikkei under a lot of attention, in addition to some of those tech stocks in China as well. We'll talk about that in a moment. The USD slipping a little bit too, down 0.1%, though over the course of the last month, we're up more than 1.5%, so has been regaining some of the ground that was lost in the first 9 months of the year. And then Brent also continues to trade weak at 62.7 is where we are right now, down 1% this morning. And switching over, people have been talking about concerns around AI bubble, around valuations, and just a mark here where S&P valuations are versus history. And I thought this was quite interesting to show, right? Because we've had a massive run-up since 2022. Valuations today, PE ratios are sitting at around 21.6. So a minor pullback from where we were, say, a couple of weeks ago, but still does tell you, in the context of history, we are sitting at pretty high levels. So something to think about there. Okay, let's also check in on how markets in Asia are faring. Min Min Lo is in Hong Kong for us, and there is a lot of red on the screen today. Min Min, break it down for us.
Yeah, traders are busy hitting the sell button this Friday morning as we digest that NVIDIA earnings, right? That rally on the first day proved to be pretty short-lived, and it's failed to quell some of the concerns around AI valuations. And you look at some of the big tech stocks, the likes of SoftBank down by about 10%, SK Hynix, Samsung also dragging the Kospi down now 3.6% lower. But you flip the board, you take a look at the Hang Seng Tech. I want to tell you about this one because it already broke below the 200-day moving average. You can see where we are here. It takes us back to the levels that we were in during the summer, and I believe we are very, very close to bear market levels. So that is something to watch. We are also taking a look at what else we're watching. If we flip the board, is the Japanese market, because a big day for Japan. We have the CPI numbers coming in at 3%, still above the target rate of 2% for the 43rd month. So a lot of pressure for the BOJ to hike rates there. You're seeing yields pointing higher, up 4 basis points here. We have Takaichi announcing her first major stimulus package, at least $112 billion in the general budget spending there. And it seems like investors are really punishing her for it. You're looking at the Nikkei, the topics is down, the yen also weakening as well. The finance minister this morning warning that they might be open to making actual FX intervention just to correct some of the excessive FX moves that we are seeing here.
Min Min, thank you so much. Min Min Lo in Hong Kong. Well, switching over to earnings now, Investec's interim profit declined for the first time since 2021 due to a slowdown at its Southern African unit. Let's head now to Johannesburg, where our chief Africa correspondent Jennifer Zabazaja is speaking to the financial services company. Jen.
Thanks, Jumana. Yeah, Investec's interim profit did decline for the first time since 2021 as a slowdown at its Southern African business offset gains at its UK operations. The specialist lender also says that they're planning to take its private banking offerings to mid-sized corporates in the UK and South Africa. Joining us now is Cumesh Moodliar, the CEO of Investec South Africa. Cumesh, thanks so much for being with us this morning. Let's just start with some of the performance of your Southern African business. What should investors be reading into the performance, especially considering, at least here in South Africa, we've been seeing green shoots. What does this mean for the current stability that we're seeing in South Africa and potentially the performance of the bank moving forward?
Thanks very much. Morning, Jennifer. I think just looking at our South African business, one has to see it in the context of the H1 of the prior year. In the prior year, our earnings were also buoyed by an increase in investment income, largely off a listed equity stock we held within our group investment portfolio in SA. So that aside, if we look at the underlying earnings drivers for the bank in South Africa across lending activity, deposit raising activity, funds under management in our wealth business, all of those are actually up year on year. In taking into account actual activity levels, we're comfortable that we're seeing good activity levels. We have also over the period seen a slight uptick in costs. Some of this relates to investment in some of the growth strategy we've spoken to the market about, including the corporate mid-market offering that we're taking to clients in a segment of between 30 million to 1.5 billion rand of turnover. So a segment that we already have some footprint in, that we intend accelerating our growth footprint over the next 5 years, both in South Africa and in the UK.
Cumesh, let's just stay in South Africa, because there has been a bit of at least green shoots, optimism for the direction of the economy. Do you sense that this is actually a meaningful turning point, or what are you assessing at this point?
Jennifer, I think if we look at the SA macros at the moment, we've actually shifted from, I think 2024 was a year of positive sentiment. 2025, I think, can be more summed up about delivery and execution. And when I refer to that comment, what I'm really referring to is the fact that you can see tangibly an improvement in core economic fundamentals. The fact that we're entering a more benign inflation rate environment, that the monetary policy sort of medicine that the Reserve Bank has been administering has really taken effect in a positive way. Inflation's under control. Yesterday, the MPC met, and we obviously saw the first interest rate cut. And I think ultimately, over time, the consumer will benefit from lower lending rates, lower interest rates, as well as a lower inflation environment. So I think that's a core fundamental shift. The second has been the fact that we have come off the FATF grey list. The third would be that we've also got the positive rating from Standard & Poor's, that we've had ratings upgrade. And those are all showing the trajectory of some of the significant work that's been undertaken through the Presidential Structural Reform Program under Operation Vulindlela. So I think there's been a key shift. The only thing I would add is that we really need to continue moving with speed in terms of some of these public-private partnerships to unlock the rail and port corridors to become really globally market competitive.
Cumesh, let's just talk also about the G20. We've been reporting on sort of the public spat between the U.S. and South Africa. What's your concern here for how this could potentially derail any sort of consensus at the end of this summit?
I think it is obviously significant. You've got one of the world superpowers not attending. But with that said, Jennifer, I think the fact that I've attended a number of aligned events with the B20 aligned to the G20, and what's been clear to me has been a high level of engagement across a number of other countries, both Europe, UK, other countries in the East, China, India, etc. All of that highly engaged sets of debates, business-to-business engagement, and the idea that people are really talking and understanding that the concept of multilateralism as we currently know it is shifting, and the shift is to more bilateral relationships. That's unfortunate in many ways, but what you can see is governments adapting to the new normal. And I'd say, looking through the noise, looking through the headlines, what we've certainly seen has been really good engagement, good traction with global counterparties on trade, on relationships, on international support. And one would hope that in time there would be some engagement with the US to close out what's really been an unfortunate set of events.
What would you say is perhaps the most important recommendation that should be carried forward with the U.S. taking over the G20? There have been some proposals for an overhaul of Basel III. Is that something that you, as a CEO of a bank, are looking closely at?
I think it's really key that banks work off the same playing field internationally, and I think we're currently sitting in a situation where the US's approach to Basel III is different to the Europe and UK in some respects. And if we could get a consensus view for global financial markets, for stability, for international trade, and for competitiveness, it would be very, very helpful to have a level of consensus and also a level of capital requirement that allows particularly developing markets and easier access into the international trade flow. My concern would be that we sit in a situation where potentially emerging market financial institutions carry a heavier capital burden than some of their developed market counterparts. And that would be restrictive to trade, development, and economic growth.
Yeah, and we know that has been a priority for the B20 and the G20
Yes.
here in South Africa. We will leave it there, though, with you. Appreciate your time, as always. Cumesh Moodliar, CEO of Investec South Africa. Thank you so much for your time. Jumana, back to you.
Yeah, fantastic interview, Jen, and great to hear an industry leader voice ahead of this G20. Now, for a look at some of the other stories we're following this morning. Egypt has left interest rates unchanged, with the benchmark deposit rate at 21% and lending rate at 22%. The central bank cited caution after inflation quickened for the first time in 5 months. Inflation accelerated to 12.5% in October, driven by a jump in housing rents. Saudi Arabia's Air Force owes the Pentagon $13 million of a $19.7 million bill from U.S. aerial refueling operations in support of Saudi coalition-led airstrikes in Yemen. An undisclosed report from Defense Logistics Agency directors said the Royal Saudi Air Force attempted to remit full payment multiple times, but each payment attempt was unsuccessful due to internal financial system issues. Coming up, crypto markets extend their slide. We discuss the drop next and what's going on there. That is coming up. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Well, crypto markets have extended their great crash of 2025, quote, with Bitcoin trading around $86,000. Bloomberg reports more than $1 trillion worth of wipeout across the digital asset world. Joining us now is Rachel Pether, head of MENA at 3IQ. Really good to have you with us. There's been a lot of focus on what's been happening, not just in global equities, but also in the crypto space as well, with that huge pullback. We're sitting at around $86,000 now in Bitcoin. Who is selling, Rachel? Is it institutional clients or is it retail?
So thanks so much, Jumana. Great to be here. So from our vantage point where we sit across ETF and hedge funds, the majority of the selling pressure has actually come from retail investors. And let's not forget that retail is often momentum driven. So that's really been where most of the selling has been coming from. While institutional investors, we actually see them either continuing to accumulate on this side. And this is whether you look at, say, the treasury holding companies like Strategy. Michael Saylor announced earlier this week that he was buying an additional 8,000 Bitcoin. So really it has been momentum retail driven from our vantage point.
You know, since you mentioned Michael Taylor's Strategy, I was reading a note the last couple of days. Analysts at JP Morgan have said that its strategy could lose, the company could lose its place in some of these indices like MSCI and NASDAQ 100. If that does happen, then it could bring about forced selling to the tune of billions of dollars. How much of a catalyst do you think that could be for perhaps a further leg down in Bitcoin?
Well, I think you have to look at the role that some of these treasury holding companies originally played. So they were really the quasi Bitcoin ETF before Bitcoin ETFs were actually available due to SEC regulation. And now we have seen a number of new Bitcoin treasury holding companies, but also treasury holding companies in other areas. I also think it depends on what their entry point was. And some people are still using this as a proxy for getting into the Bitcoin market because their investment parameters allow them to invest in equities, still doesn't allow them to invest necessarily in digital assets per se. I mean, you also need to look at this in the context of the greater market and some of the recent events that we've had. There is fear in the market right now, but I think that is also natural reaction to what's been happening with the mass deleveraging event that we saw in October, and the 19 billion was wiped out, which was almost twice the size of the FTX in 2022, the crash there. And what we're seeing in the market now in terms of the fear is that it's almost like an aftershock in an earthquake. There were two key parameters that had this happen. You had the crowded positioning and you had the excessive leverage. And so after a period like this,
I was going to ask you about that.
Natural. Yeah, so maybe we just do rewind.
Yeah, so how long does it take to clear out? Yeah, how long does it take to clear out the extra leverage in the system, since you think that's one of the catalysts for the drawdown that we're seeing?
You actually mentioned the AI valuations earlier in your piece, Jemana, and how you have to put it in the context of recent history. So I would like to do the same here for digital assets. So we did have the surge of Bitcoin to over 126,000 earlier in the year. And then we had the massive deleveraging event that happened on October the 10th, like I just mentioned. Now, while the severity of the crash was geopolitical, you had President Trump's 100% tariffs on China. It was largely due to leverage in the system and the crowded positioning. A lot of that has been flushed out, and we actually expect that we're towards the end rather than the beginning of that. So we expect a period of consolidation around 90,000 before the broader uptrend actually continues.
Yeah. Okay. I was going to ask you about where you think we stabilize, and we're just a bit below that, so probably around these levels then. The other phenomenon that's taking place is the dollar has been strengthening. Is there still somewhat of a correlation between the USD and Bitcoin here? I remember earlier in the year we were talking about money perhaps moving away from the US dollar into other assets like gold, like Bitcoin. With the dollar strengthening, does that perhaps pose a challenge to some of the upside thesis?
I think Bitcoin has a number of macroeconomic drivers, and you've also got to look at, in parallel, there's a lot of the rise of stable coins in the digital asset space, which is really helping to lift the entire market as well. I think that the Bitcoin price and the US dollar price, it also was historically correlated to the money supply as well. And a lot of the price movement that we saw earlier in the year was an anticipation of Fed rate cuts as well as general adoption and increased investor sentiment coming out of the US, which was increasing institutional adoption.
Yeah. Rachel, really good to have you on today. Thank you so much for sharing your perspectives. Rachel Pether, head of MENA at 3iQ. Thanks. And coming up, stocks are poised for their worst week in 7 months as concerns over valuations and AI investments prompt an investor retreat. We'll unpack the market action next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Bersachi in Dubai. Well, stocks are poised for their worst week in 7 months as concerns over lofty valuations prompt investors to retreat from riskier assets. For a deeper look at how markets are doing, Bloomberg executive editor for Asian markets, Paul Dobson, joins us from Singapore. Paul, what is the catalyst for this major sell-off that we got yesterday? I walked in and we thought things were going to be good because of NVIDIA earnings, and then sentiment sharply turned south throughout the course of the day.
Absolutely did, Jemana. And the worrying thing, I think, perhaps, is that we didn't really get a very clear reason for the move. So all the old theories come out about valuations, about concerns about, the tech long-term view in its ability to make money, people's ability to fund the spending for all of the NVIDIA chips that they need to buy, and people kind of like pouring through the NVIDIA accounts to try to figure out exactly how sustainable that picture looks, and sort of coming to the same conclusion that they seem to have reached in recent days and weeks, which is that people just are worried, right, about can this really deliver? Can we fund all of the investment in data centers that is being touted and mooted? Will that investment make a return? Will the chips still be working and useful 3 years from now, or will they already have been surpassed by faster, better, superior technology as well? So lots of reasons for people to be worried. The pattern that we often get after NVIDIA results in any case is a little bit of a profit take. So no need for despair just yet. But it was that sharp shift in sentiment, and this really kind of like filtered through to the Asia region today with the tech-heavy gauges in our markets all under a lot of pressure as well to end the week.
Yeah, one note from an analyst on the street caught my attention yesterday. Deutsche Bank's George Saravelos saying that this is something we really need to be worried about, which could be Japan's trust moment with the budget that's going to be unveiled. Some big numbers being put forward. Seems like the budget is going to be 27% bigger than what the Prime Minister's predecessor unveiled a year ago. How much of a market driver is that this morning for the Nikkei, but also more broadly for Asian equities? Is there real fear of spillover there?
I think that you have to separate a couple of things here, because actually Japan's domestic market is doing okay. So if you look at the Topics index, it's more or less unchanged. There's a couple of things going on there. Both the car makers are benefiting from the weaker yen, but also, the sense that there will be some support for the economy could be taken as favourable for companies that generate most of their revenue at home. But the Nikkei is part of the tech drawdown, the downdraft there, taking a lot of the companies on that gauge down a significant distance today. Look, I think for the Japanese budget, don't worry about the equities so much. Focus on the bonds and the currency, though. We had another warning from the finance ministry today talking about how it will intervene physically in the markets by buying the yen and selling the dollars in order to stabilize the currency if it needs to. And that sort of left us with some sense of equilibrium. But the pressures have been there. People are worried about whether Japan can actually afford the budget plans that Takaichi is putting forwards, whether it's going to deliver the growth that she's promising in order to bring down the sort of debt to GDP ratios that people are so focused on. And if you look at how the bond market has performed this year, or in fact this week, it's been kind of troublesome. We've been setting new highs on yields, and that's spreading back towards the nearer end of the curve. People looking at the 5 to 10 year section. If the Japanese were to lose control of those interest rates, then that would definitely be a pretty scary picture, particularly if it's sliding at the same time as the yen. So that, I think, is where it could, in fact, it's global markets, and that's really the pressure point you need to pay attention to.
Yeah, very good point on where yields are trading. Though this morning, we're actually coming back down a little bit. So buy the rumor, sell the fact. Paul Dobson, Bloomberg Executive Editor for Asian Markets, thank you so much. A quick look at equity futures. Well, Paul was just describing to us what went down yesterday, some of the concerns in the market, but things are stabilizing this morning, at least for U.S. equities. Not the case for European markets, which look like they're going to open up deep in the red, down 1.5%, playing a bit of catch-up with the U.S. price action. Well, that is it for Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.